I was still able to sell my business, but I left money on the table because I was way undereducated on all this stuff. Wouldn't it have been interesting to pulse check enterprise value along my entrepreneurial journey and understand what are the value drivers? What puts risk in the eyes of a buyer when they come and they evaluate a company? Because if only 30% of businesses are selling that go to market, if that were our homes, we'd be turning ourselves inside out to figure out, like, what do I have to do to get in that 30%? And business owners, by and large, really aren't doing that. And that's the big opportunity for them.
Jeff Armstrong, welcome to the Sideshed podcast.
Thank you, Matt. Excited to be here.
We should definitely give a shout out to our colleague, Cam Bishop. Cam introduced us off the back of a two-part series I did with him, which was around building and selling a profitable trade business. As I mentioned offline, we covered some amazing content in that little series there in relation to the things that you can do to sell a business, some of the mistakes you might make, understanding when the right time is to sell, so on and so forth. But one of the questions that I had in the podcast was really geared around how to prepare the business from the beginning so that it is something that can be acquired potentially. And Cam said, you know what, that's not really my wheelhouse, but go and speak to Jeff. So here we are.
Yeah, I appreciate him connecting us. Raincatcher and Cam have been a partner for us for a few years now.
Yeah, awesome. So there's been, as I mentioned as well offline, there's a bit of a growing interest over here now with trade businesses understanding that. I mean, look, if you circle back 15 years, it was always a case of, well, I am my business and no one would ever buy it, for that reason. And then all of a sudden, over the recent few years, there's been this sort of movement towards the amalgamation model, private equity, buying up companies and things like that. And excitingly giving business owners over here a way that they can, get rewarded for the business they've spent the last 2, 3, 4, 5+ decades building. So yeah, it's a very interesting conversation. There was a great event that we went to in Sydney a few weeks back, which was put on by the folks over at Service Titan. And I guess they're kind of championing this movement to a degree based on, I suppose, the fact that a lot of private equity firms want to make sure that when they do acquire a business, they've got firm, solid systems in place so that it's an easy acquisition and they're familiar and they can, so on and so forth. So I guess in this podcast, what I'd like to address are some of the things that we need to do to prepare the business to the point where it can then be, saleable. We've covered similar topics in the past. I feel like this is something that never really goes away. It's always like, I guess there's a lot of evolution within this space, certainly over here at the moment, that's for sure. So it's pretty exciting. So looking forward to, gaining some insight from you. Before we get started, do you want to give us a bit of a background as to what you guys do?
Yeah, Cultivate Advisors, we're a company that helps other businesses grow and scale. We always help the business owner look at the business through the lens of enterprise value. That seems to be a gap for many owners. They're not necessarily looking at their business as an asset. And so our whole brand is all of our business advisors. We have 45 business advisors scattered around North America, all our former business owners who have started, grown, scaled, and successfully exited multi-million-dollar businesses. And now they work alongside other owners and entrepreneurs who are looking to do something similar. Mm-hmm. And I would say that probably 65, 70% of the business owners that come to us, are introduced to us, are curious about us, are just looking to optimize their business. They want to increase revenue, profit, the owner's income, create operational efficiencies, get time back from the business. And then the other, 30% or so are looking to exit. They're typically looking to exit in 3 to 5 years, or they have a specific number they want to hit and they need help reverse engineering how to get there. And so our whole brand is, everybody at the company, it's unique this way, is a former business owner. Virtually everybody, not just the business advisors. I owned a business for 23 years here in Chicago, where I'm based. And so we have that kind of that felt experience of being a business owner, the emotional roller coaster that can be. And
The
uh,
scars.
what's that?
The scars.
The scars, right? The battle scars. And so we've kind of, our advisors definitely have a been there, done that feel. But everybody in the company, believes the world's made better by entrepreneurship. And so we're here to help make the world better for business owners and entrepreneurs.
Awesome. So I guess in this podcast, what are some of the key things that we're going to unpack just so we can give the listeners a bit of a taste of what we're going to be discussing?
Yeah, I think, one of the big blind spots, business owners are superheroes, but all superheroes have flaws and blind spots. And one of the big blind spots is that businesses aren't being built necessarily to transfer ownership. And so one of the big blind spots is that the business owners tend to look at their business as an income producer.
Okay.
In my case, it was a piggy bank and an income producer. Um, but switching that paradigm to enterprise value and helping a business owner look at their business through an asset is such an opportunity for not only the advisory partners that work with business owners, but also for business owners just to kind of sink in and understand, hey, what is the enterprise value of the business? How easy would it be to transfer ownership to another party, be it private equity, be it a strategic buyer, or maybe they want to pass it down to the next generation? Like, how easy is it to transfer ownership? And the big blind spot for most business owners is that they're not set up that way. And so there's blind spots around that. That's a big one. But business owners get into business typically because they're technically proficient at something, or they see an opportunity, or they're very passionate about something. Ideally, it's all three, right? But they get in because they have a specific skill set. But then, okay, now you're a business owner. Now you've got to know financials, and you've got to understand people, right? You got to do leadership and recruiting and sales and marketing, and then what's the tech enablement for the business and productivity systems. It's just really difficult to be an expert in all those different areas, all those different hats an owner has to wear. And so, part of it is identifying like, hey, where are the gaps in the business, and what does it make sense to focus on in pursuit of working on the business rather than just in the business.
Got it. I guess it's certainly true for trades. I mean, a lot of these things that you just mentioned then, you're never taught when you go through technical college. Over here, we call it TAFE, whatever it might be, but where you essentially learn the skills of the trade. There's very little emphasis on, how to run a business. So you kind of have to go and acquire that knowledge off your own back, on your own accord, essentially, So I guess that's a pretty common conversation that we have with businesses when they're helping them understand things like financial. I mean, look, truthfully, I used to be a plumber myself. This was absolutely my experience. You finish your certificate, they give you, they say, right, here you go. This is you can now run a business. You can now own and run a business with absolutely no idea how to run a business. All you can do is dig a trench and lay pipe, So it's, I guess when most people start out in business, as you kind of alluded to, they're not starting out with the end in mind, perhaps through no fault of their own. Perhaps they're doing it because they're sick of being told what to do by a boss. As you say, maybe they've seen an opportunity. There's a number of different reasons why people get into it, but I'd say probably the majority wouldn't be starting with exit as at the forefront of their minds when they start a business. So I guess what would be super useful for the listeners and viewers out there is how, it doesn't take long when you're in business to understand, especially depending on the circles that you navigate towards. Truthfully, we're kind of preaching to the choir here with the listeners and viewers of this podcast because most of these guys are pretty savvy operators, so they kind of understand these concepts, but like to a degree anyway. Perhaps they're not implementing. But I guess what my question to you would be, and my hope for this podcast is that we can give people that already have sort of an established business a bit of a roadmap on the things they might be able to do in order to have something of value at the end of the day that they can potentially, be acquired for.
Yeah, absolutely. I think to your point, most people get into business to get some level of freedom, right?
Mm.
You mentioned kind of getting away from the boss, or doing things in a different way, or maybe treating their employees differently than they were treated. But a lot of that has to do with freedom. People go into business to create more freedom for themselves, more legacy. And then the ironic part is they get bogged down with all the day-to-day operations, all the different hats they have to wear. And the
Yeah.
next thing you know, they're just kind of like they put themselves into another job. And I think when you shift some piece of your focus to the end in mind, what you're doing is you're rekindling that freedom, that spirit for freedom. Like what is your freedom point with the business? What, even if you don't ever want to sell, can you elevate yourself, the dependency on the owner, to the point where you can go on long vacations. You can work. I talked to a business owner today. She owns a logistics company. She works 4 hours a week. Um,
In Paris.
yeah, yeah, to Paris. That's what I said. She goes, I'm doing it to a T. So she got herself to a place where she's working. She's literally working 4 hours a week. I mean, that's a level of freedom that she's got this great business. It does, I think it does like 5 million in top line, and I think it was about 600K in EBITDA. And so she's got a nice, healthy business that's cash flowing, and so she's created freedom for herself. And she's talking about exit and when she wants that to happen. But for the most part, she's exited operationally.
Well,
Um,
this is a question, right? Like, why would you want to exit that business if you
yeah,
like? That's, I mean, I know you mentioned before, like the whole cash cow scenario, but like, I mean, if you work 4 hours a week, I can't imagine you're going to exit a business and you know find anything better than that.
I know. She's getting a little older. I think she just wants to, she's
She really wants to
investigating like
reclaim
what.
that 4 hours, right?
Yeah, yeah, right. It's grinding her to a nub.
Oh, classic. Um, what you mentioned before, enterprise value. What is that?
Enterprise value is the measure of a company's total value. So a lot of people think enterprise value means selling a business, but it's really just a way to keep score.
Measured in
Like,
dollar value or goodwill, or like what are the metrics here?
yeah, so the way we measure it at Cultivate, we do kind of a high level. We take revenue or profit. Typically, it's profit. It could be 3 years, it could be 12-month trailing. We do a health score of the business, like what are the how does a company measure up against best in class systems? The things that if private equity comes in and evaluates your business, that they're going to discount you. They're going to knock down the value, beat you up a little bit on the value of the price based on how the company's set up. So we call that the health score here at Cultivate, to keep it very simple. So what we do is we take the multiple range for a specific industry. So it could be HVAC, right? That exists with a certain multiple range. It could be, I don't know off the top of my head, but it could be 2 times EBITDA on the low end. It could be 9 times EBITDA as best in class. Well, that health score helps inform where are you on that scale? Where's the business on that range, that multiple range?
Mhm.
There's other factors that go into play, growth rate, the size of the company, but it's a high level way for us to start to pull back the curtain with a business owner to understand, hey, what's the value of the company? Not just the profit, but also what's the multiple? The magic's really in the multiple. If you grow profit and the multiple, that's when things really get exponential. And so, yeah, it's really a way to keep score. That's the way we explain it to our owners that we work with. It's not unlike, why do you look at Zillow or Redfin or whatever the tool is that you look at your home's value on the internet? Like, hey, what's my home worth today? Well, it's interesting to know because it helps inform you, not only what your net worth might be, but also what does it make sense to invest in with the business. Now, the interesting thing here is, you know, only 30% of businesses that go to market actually sell.
Mm. And
Only
why?
30%. Have you heard this stat before?
Yeah, I have. I'd love to know why.
Yeah, I think a big piece is that the owners are looking at their business as a job, as an
Yeah.
income producer, not an asset. They're undereducated about enterprise value.
Mhm.
They're not thinking with the end in mind. I think exit is kind of a dirty word. I think I liken it to, and hey, I raised my hand too, right? I was a business owner 23 years. I didn't have a clue what my business was worth until the turkey timer went off and it was time to tap out. Like I was done. Um, I was still able to sell my business, but I left money on the table because I was way undereducated on all this stuff. Wouldn't
Mm.
it have been interesting to pulse check enterprise value along my entrepreneurial journey and understand what are the value drivers? What puts risk in the eyes of a buyer when they come and they evaluate a company? So
Mhm.
I liken it to like we don't think a lot about being separated from our bodies. We just don't think a lot about death. I think exit equals death for a lot of business owners. They don't spend a lot of time thinking about it. So
Mm.
yeah, enterprise value. If only 30% of businesses are selling that go to market, if that were our homes, we'd be turning ourselves inside out to figure out like what do I have to do to get in that 30%.
Yeah.
And business owners, by and large, really aren't doing that, and that's the big opportunity for them.
You touched on something like when it comes to exit, which like we see quite a lot occurring, and it's kind of selling through through desperation. Like maybe it's a health
Mm,
scare, maybe it's a
yep.
divorce, something along those lines. Which I guess from a buyer's point of view is like amazing news, right? Because essentially they've got all this like leverage. Um,
Yeah.
in this conversation around like what we're talking about today, are we going to unpack how you can sort of create a business which um, is sort of mitigates that dynamic?
Yeah. Yeah. Absolutely. Yeah. I'll touch on kind of what we call the 5 Ds,
Okay.
which is death, divorce, disease, distress. I forget what the fifth one is, but it basically is life throwing you a curveball, right? Where life throws you a curveball. And I've met some, in my role here at Cultivate, I talk to 5 business owners a week coming in wanting to know more about Cultivate. And I, I, I've seen it all, and it really is heartbreaking when you get a spouse that doesn't know how to run the business and
Sure.
it's spiraling downward, or somebody has a disability, something's happened to the owner and they can't function in the same way around the business. And you know oftentimes these businesses they spin down, they
Hmm.
spin down because life threw them a curveball.
Hmm.
So when you talk about like what can owners do, you know we feel really strongly that every owner needs to know the enterprise value of their business, an estimate of value. They don't have to go out and get a formal valuation and spend thousands of dollars. There's a lot of tools out there that they can do it in a very low cost or no cost way. Our tool is a no cost way. Back when I owned a business, it cost at least $5,000 to get a valuation. You didn't really know how they did it. It was kind of behind the curtain. Now you
Right.
have um, valuation tools like Biz Equity. You've got our valuation tool, low cost, no cost. It's really been democratized. So there's really no barrier to get a valuation. So we believe knowing the asset value of your business is step one. And really, a business owner should be pulse checking that every year to see how they're doing.
Okay.
Um, and then you look at the value drivers, right? The big value drivers, the things that enhance the business, um, increase its value, decrease the risk in the eyes of the buyer. We have 24 value drivers at Cultivate, and I'm not going to bore you by going into each one of them, but they do
Thank you.
fall under buckets. Like the big one is owner dependency. Like,
Yeah.
can the owner go on vacation? When I was a business owner, I had 3-day weekends. That was it, literally for 20 years, other than my honeymoon, which is sad. They used to call me the Enigma machine because they said I could crack any code, but all that meant is that the business needed me and everything. I was
Right.
way too tied up into the day to day, and it really couldn't run that well without me. So owner dependency is a big one. Can the owner step away? Can the owner go on a 3 week vacation? Can they step away for even longer without being tied to a phone or a computer? Like literally disconnect. That's a good litmus test you hear a lot about. Systems, like is everything in the owner's head? For the core functions of the business, do you have documented processes that you could hand over to somebody else where they could step in and run it? A lot of times, all that's locked up in the owner's head.
Mm-hmm.
Uh, Customer concentration. Are two or three customers accounting for more than
Yeah.
50%
Yeah.
of the business? The logistics company, the lady I talked to, she actually has a customer concentration problem. Three customers account for 50% of her revenue. So
Okay.
she needs to diversify that,
Yeah.
as she wants to build enterprise value. Those are
Yeah.
the big ones. Those are the big ones that you hear a lot about. Key employee. Who makes it rain? Is it the business owner? If you pull the business owner out, does to kind of all those relationships go away?
Yeah.
So it really is. The theme is really dependency on any one key particular thing, whether it's the owner, whether it's a key employee, whether it's a vendor or a client.
Sure. Um, when we're assessing, say, like the enterprise value of a business, I mean, you hear all these stories. I mean, perhaps it's not like as relevant to the trade space, but I mean, you hear all these, stories about businesses that are worth a huge amount of money, despite the fact they're losing money on paper every year. How does that work? I mean, that's always been a bit of a bizarre one to me.
I see it in the SaaS space.
Yeah.
I don't see it a lot where companies are losing money that they are, you know, that they're worth a ton of money. Like
I
I
guess I
personally
guess the
haven't seen
question
that.
is, I guess what I'm trying to ask is, what are some of the other areas of consideration beyond immediate profitability within a business that is valuable?
Oh yeah. So you hear this concept of the four the 80% of a business's value, 70 or 80% of the business's value is tied up in the intangible capitals.
Right.
The structure, the structure of the business, the social capital of the business. What they're really saying is that it's the multiple, right? It's the profit, and what are all the pieces that influence the multiple? Do you have a company with a good corporate culture, good leadership systems in place, good social capital, good infrastructure? Um, those are, those four C's, and I that's not really our methodology, but it's something that you hear a lot around. It comes from the Exit Planning Institute, which is a accreditation association that designates a certified exit planner designation. They come up with the four C's. There's a great book out there, Walking to Destiny by Christopher Schneider, that really goes into all these blind spots that business owners have, and then their kind of methodology around um, the four intangible capitals, three legs of the stool. Like they got a lot of kind of ways to understand this. But what they're really talking about is that the value is locked up on things that are outside of profit. Profit's on one side of the equation, but what are the things that influence the multiple, whether it's a 2 or a 9 or somewhere in between?
What sort of metric, or I asked this question to the panel at the event recently I mentioned earlier, and I truthfully don't feel like I got a great response. There was a whole lot of conversations throughout the day around um, profit margins and a lot of the obvious metrics that you would typically consider, I suppose, from a cash flow perspective. But my question to them was, what are some of the less obvious metrics of growing a successful business in the space of things like, not exclusively, of course, but like building, team culture, team retention, um, customer satisfaction, like all of these other areas. Does that come into play at all with enterprise value, like market valuations?
Yeah, if you've got your clients are very sticky, like if they have a long lifetime with the business, I mean that increases enterprise value. You know, one of the metrics that our some of our business owners like to track are Google reviews. Like how many
Right.
Google reviews are they getting? How positive are they? And it's kind of like a odd metric when you think about enterprise value, but it's something that's important to them, and they actually put it in their CEO dashboard like what's their Google review count and what do those look like? Um, but there's a lot of you know ways that you can define success and measure metrics that do influence enterprise value that are outside of kind of the typical financial metrics that you hear about. Um, I think one of the ones that I like as well is like profit model, like mature profit model. Like you might be investing a lot into your company, but and you're doing that to support its growth, and it is growing. But what does the mature model look like? If you weren't putting that investment in, what does that profit margin look like? That's something that business owners talk about, things that we talk about
So
with others as
so you
well.
lost me there. What does that actually mean? What is mature profit margin against profit margin?
Yeah, so if you got a mature profit uh, margin model, like what is the business? What's the profit margin in the business if you're not investing so much into growth? Your growth is expensive.
Is that like marketing?
Yeah, it could be marketing. It could be investing
Active.
in sales team. Kind of getting you to from point A to point B. Like doing that might really kind of trim down your profit margin. But if you weren't doing those things, if it was a more mature company, what would that model look like?
Okay. So are they kind of penalizing businesses that are investing in that have marketing budget? You've kind of lost me on that one.
No, no, it's the metric. It's just a metric that's kind of outside the norm that people, that you could argue that because of you putting this investment that the margins would be higher if you weren't making those types of investments.
Sure, if you weren't spending the money on like ad spend or something along those lines, seems a bit of a
Right.
strange. Um, Seems a bit strange though, based on the fact that essentially the revenue of the business would be typically dependent on that. Well, not dependent, but like in the interest of scale and growth. And we see this all the time, right? Businesses, because as from a marketing agency's perspective, which we are, when businesses come to us, they normally come into us because they've sort of tapped out on word of mouth and referral growth. Like, and they're
Yeah.
looking for a way that they can have a bit of consistency within their strategic forecast. So they've got a way that they can sort of achieve growth with consistency, and we can kind of do that through marketing. We can help them, tick those levers and hit those milestones. Um, but they need to be willing to sort of spend the money to get the outcome.
Right. Yeah, totally. I mean, yeah, growth can be expensive, whether it's, you're doing it that way, or if you're just building a different type, you're expanding teams into new markets, like you're hiring teams and you got to get those teams off the ground into a completely
Sure.
different market, those types of pieces.
I mean, this is one of the reasons as well. A good colleague and friend of mine, Scott, who's got a huge business over here, and his model has always been growth through acquisition. Like he'll go and buy companies, essentially
Yeah.
buy their team, buy their database, plug it into their system, and then that's a fast way to growth, especially in a scenario where there's a bit of a labour shortage.
Hmm.
Of worse words, like it's quite an easy way to acquire team members to grow. To grow, and grow and acquire a database to expand your service offerings. I think for the better part, most businesses don't really have a solid marketing system in place, so they're leaving money on the table in terms of, I mean, we see this day in, day out, like the
Yeah.
amount of businesses that are just so caught up in generating more leads at the cost of their existing customers almost every time.
Yeah. Yeah. It's funny. Our assessment tool, we call it the business health and value assessment
Yeah,
because we're really quantifying the health of the business across different dimensions. And so the dimensions are financials, sales, marketing, leadership, recruiting, and productivity. And it's just a good place to start to peel
sure.
back the onion. I would say marketing is one of the two where they score themselves the lowest. There is no shortage of business owners that are struggling really kind of to crack that marketing game.
Yeah, I think in my experience, the real the reason for that is especially when they've coming out of sort of organic growth. So they've sort of grown through referrals and word of mouth,
Yeah.
and in just without really having to spend money. Then all of a sudden they're put into this world where they need to have as part of their operational expenses, they need to consider marketing budget. And it's not that it's better or worse. It's just that they've never had to do it before. So all of a sudden they're like, well, you need to be allowing for this much within your product price now to account for growth through marketing. And they've never had to consider that before. So
Mm-hmm.
it's just, I guess, a learning curve more than anything, but it's a very common, it's probably the most common conversation that we have, especially when you look at, when we onboard new clients and we say, okay, well, what are we shooting for here? What do the goalposts look like? What's the target? They tell you and they go, okay, well, this is achievable provided that we do these things. They're like, oh, and like in order to get to this mark, like we can get you there, but you have to spend this much money to do it. And we're not suggesting you have to do that today, but over the next 12 months, we're going to have to scale to that. And
Yeah.
that's kind of a bit of a, I mean, for better or worse, that's the reality, right? Like we're not going to try and sugarcoat it for them. If they want that outcome, you've got to do the thing. So,
Mm-hmm.
but it's almost always a surprise to them because they've never had to consider it before.
Yeah, yeah, especially like you said, the growing word of mouth, it's referral based. Like there are other sources to get leads beyond that. And then like how do we crack the code for those different sources?
Sure. Yeah. Um, so I'm going to have links to the health and value assessment that you guys have within the show notes. So for you listeners and viewers out there, just if you want to head across to the site shared, just search Jeff or Armstrong. Maybe he's probably better. There's probably thousands of pages will pop up for that, or Cultivate Advisors, and you will be able to get to that page where you'll be able to link through and do that assessment. Is that typically, Jeff, in your experience, the first sort of stepping stone where you'd be like, right, well, let's just sort of see what we're working with here?
Yeah, I would say it's usually step two. Step one for us, most of the business owners that come to us through referrals. Like you mentioned Cam at Raincatcher.
Yeah.
He takes businesses to market, but he meets so many businesses that just aren't ready to go yet. And so he'll make an introduction to Cultivate, like, hey, go through their assessment. They'll help you build a plan. Um, you know, that's no cost, no obligation, no hard sell. If they want us to help them implement the plan, that's when we charge for subscription based advising. So, really, the first step is hopping on a discovery call with someone at Cultivate. I do my share of discovery calls with business owners, really just trying to learn more about their business. Where are they at now? Where do they want to go? What does that perfect future look like? Maybe what are some of the things that they're contending with, where they see opportunity in the business. So I'm getting a real high level feel of the business. I share more about Cultivate on that call and what we're up to. And then I invite them to take that assessment, which is email it out as a link. So it
Okay.
takes a business owner 15, 20 minutes at the most to complete it. They're putting in their revenue, their profit, their industry. They're answering those questions, those 24 value drivers, self scoring themselves. And then they're going to get an estimate of value. They're going to understand where we think they might be on the multiple range. They're going to see what best in class looks like as well. We share that in a pretty cool graph. And then a health score across those different dimensions. And it's just a good place to start. Like it's not the end all be all, but it's what our advisors use really to start launching the conversation from there and starting to peel back the onion on the business and see like where does it make sense to focus time and energy on in pursuit of working on the business, and in what priority would we recommend you do that.
And is that the plan? Like when you talk about how we'll create a plan so that it can scale towards exit, is that what you're talking about? It's like, okay, what different areas and what levers do we need to pull to work towards that?
Yeah, the strategic plan, something we call kind of a prioritized action plan or a growth roadmap. depending on the advisor. But that's something that, yeah, our advisor will sit down, take a look at that assessment. They review the call that I had with the business owner. They review my notes. So they do research on the brand. They come fully prepped, ready to build that plan, but they're building that strategic roadmap in a way that not only addresses enterprise value, but it also addresses, what's the vision and goals of the owner? Like,
Mm,
what do they want? What do they want the future to look like? What do they want the business to look like? And so it always is connected to the vision and goals of the owner. The plan we put together are actually roadmap items that we suggest they take and gaps that we feel that they should close. We come in as you know, an objective entrepreneurial perspective that's not caught in the day to day. As if we were going to invest $1 million in the business, this is what we would recommend if we were in your shoes.
mm.
If they work with us, we operate at the level of a partner you don't give equity to. Um, but that plan, yeah, we build that plan coming out of that assessment and coming out of conversation with the business owner.
And just, I suppose, before we wrap up, what typically are those, like within the roadmap, some of the more common levers that you guys do see, consistent trends in things that need to be improved?
Yeah, usually the financials have to be very clear. Like sometimes and sometimes we have to send them to a bookkeeper just to get their financials clean. But we're looking at their financials, like do they have the right P&L? Do they have the right debt to equity ratio? Do they
Mhm.
know the margins, across their jobs? Do they have the right profit margins? We're looking at those different categories, financials being one. And then you've got the growth side, right? Like our methodology, the metaphor is an airplane propeller where the engine is the financials. Then you've got the growth side propeller blades, sales and marketing. Then you have the capacity side propeller blades. It's the people, right? It's the leadership systems. It's do we have the right people in the right seats doing the right things? And then productivity and tech enablement encapsulates it all. That's the metaphor we use to help a business owner break down a business and then how we holistically advise a business. So they fall within that. Those roadmap items always fall within those categories, and then we have systems within each category that we will spend time and energy on, or recommend they spend time and energy to improve.
Sure, got it. Okay, interesting. All right, well, this has been great. I think for all you listeners and viewers out there, the clear message is like you do potentially have a valuable asset, provided that you build it the right way. So don't for a second think that you guys are just grinding away day to day and there's going to be nothing left on the table at the end of the day. Like we're seeing more and more of these stories appearing. We've seen it for a long time abroad, but certainly, in the local market, over here now as well, where people are getting, good multiples and good value for their exits. And I think these conversations, Jeff, are super useful because, and I thank you for that, because truthfully, there's, for better or worse, a huge level of ignorance when it comes to these things, based on the fact that we typically trade business owners. We just don't have access to this sort of knowledge, So, thank you for taking the time to share some of these, share your wisdom with us and the listeners and the viewers. Is there anything that you would like to wrap up on before we close off?
No, I think you hit the nail on the head. Like it's a big blind spot. Knowing the enterprise value, knowing what leverage you can pull to increase it. We're not trained on this. Nobody's coming out and shouting it off the mountaintop. But I think it's changing. Like, I think part of it is private equity is dipping their toes into different areas, they're coming down market. And people are hearing these stories where they are getting purchased by private equity, especially in the trades. And so this is creating more awareness and more buzz around, hey, what could my company be worth? Where do I sit in the health and the value of my business? Like where am I in that multiple range? So I
Mm.
think that the tides are turning, things are changing, and all it's going to do is create better outcome for all business owners.
Yeah, I think that's largely due to as well a lot of these big names now that are sort of championing these movements and being pretty public about it. Your Tommy Mellos, your Tom Howards, your Ishmael Valdez's, and all these guys that have done it well and continue to do it, So I think, like you say, the awareness is rising and people are definitely taking an interest. So anyway, I appreciate your time once again. Where's the best place for people to get hold of you, Jeff?
Yeah, so our website is www.cultivateadvisors.com. I'm in LinkedIn, Jeff Armstrong. And then my email is jeffa@cultivateadvisors.com. If you have any questions, need any resources, or I would like to pick my brain about anything, we're always open for that.
I'll put links to all that in the show notes. Guys, head across there, search Jeff Armstrong, and you'll be able to get access to all that. So you don't have to worry about pausing and pulling over if you're on the driving. Otherwise, Jeff, thank you once again for your time. Much appreciated. And listeners and viewers, if you have any questions about anything there, if there's something we haven't covered off on, by all means, let me know. Happy to try and rubber arm Jeff to get back on the show and answer some of those questions. Otherwise, thank you for your time, everyone. And thank you, Jeff, for your time.
Thank you.
Hey guys and girls, how would you like all of the value adds left behind from our podcast guest all put together in the one spot? We've pulled every tool together, every template, every resource shared on the show, and we've packed them all into the Tradie Academy. It's free to join and it's built by the team behind the SiteShed and Tradie Web guys. Inside, you'll get marketing tips, business tools, and first access to future resources, all in one simple dashboard. Just head across to tradie.wiki/pod. That's tradie.wiki/pod. The link's in the episode description. And once again, you just log in once and then you're all set. And if you want to get notified of upcoming episodes, hit subscribe or follow.